Good afternoon, everyone. Welcome to Nova 401k Associates webinar on cash balance plans for advisors. Today's webinar is eligible for CFP, ASPA, and IRPA CE credit. Due to the timing requirement of CE submissions for some of the designations being offered on this presentation, it is very important that you complete the survey that will pop up at the end of this webinar. Specifically for CFP CE, please make sure you provide us only the last four of your Social Security and your CFP board ID. We have also added the slides as a handout. Click the handout dropdown on your GoToWebinar panel, and you can download and save the file to your local folder. Today's presentation will be presented by Ernie Galini, who is a Defined Benefit Account Manager here at Nova. If you have any questions, please type them in the questions box, and we will answer them throughout the presentation. Ernie, we're ready when you are.
Thank you, Jasmine. Good afternoon, everyone. Welcome to our annual cash balance plan presentation. My name is Ernie Galliani. I'm an actuary here at Nova 401k. In case any of y'all did not know this, an actuary is a professional who can solve a problem you didn't know you had in a way you can't understand. I get accused by that by Russ Hooker, our head salesman here at Nova all the time. Anyway, by the end of today, y'all should be pretty familiar with the power of the cash balance plan. We can generate some pretty darn good deductions for your clients and help you increase your accounts under management. So with that, we'll kick off here. Disclaimer, this information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional such as an attorney or accountant if you need legal or tax advice. And one of the things I like to recommend to all of our clients and our advisors is it's always a great idea to ask the plan sponsor's CPA to do a mock tax return once you have a plan designed in there, just to confirm that the deductions that you're trying to get and that there's enough compensation earned by the owner to justify the benefits. Intended audience and prerequisites. Our intended audience today is financial advisors, CPAs, and clients. And prerequisite is just a general knowledge of retirement plans such as 401k and profit sharing. See our today's agenda. We'll start with a little cash balance teaser, introduction, different plan types, investment vehicles. Then we'll zero in on cash balance plans. We'll go through a list of frequently asked questions about cash balance plans and take questions. But I'll encourage y'all to ask questions throughout the presentation whenever it occurs to you. And if any of you all already know you have some questions in advance, go ahead and ask them, and I'll be able to see what those questions are, and I'll be able to fit them in the presentation, maybe during a slide that it ties with it pretty well. All right, so let's talk deductions. So in this chart, we'll get down to how we get to this, but this is sort of where we're going to end up at the end of this presentation as well. On the left-hand column, you'll see the ages starting at 45, and it goes all the way to 64. It was 65 a few minutes ago, but we have the age, we have the amount of compensation that's needed to generate the deduction on the deduction column, and then if we're talking about an owner-only plan, the maximum profit sharing is 6% of compensation, and then to the right we've got combined defined benefit deduction and profit sharing deduction. For some of our bigger clients that are covered by the Pension Benefit Guaranty Corporation, we can get a profit sharing deduction up to $58,000. So these combined deductions can be even higher. In addition to that, especially in these owner-only plans, as the pension plan matures and gets into year 2, 3, 4, and 5, we can actually get deductions even bigger than what you see on this chart, because IRS will allow the plan sponsor to fund 50% more than is needed. So that some these are generally set up to be funded evenly over 10 years. But if a plan sponsor has the cash flow and the desire, the plan can be set up for a 10-year plan, but you can fund it maybe over 5, 6, or 7 years and take all the deductions in the early years. You will wind up with the last 2 or 3 years not being able to take a deduction, but some plan sponsors prefer to take the deduction now rather than later. So pretty good numbers here. As you can see, the combined deduction gets up over $300,000. If you have some clients who are actually beyond age 65 and even in their 70s, we can often get deductions, $350,000 and more a year. So pretty powerful vehicles, and obviously with this tax environment and taxes about to get even higher on us, these are really great vehicles to tax defer with. All right, so introduction. Qualified retirement plans have always allowed for tax deferral. Provides a current tax deduction for the employer, deferral of income taxes on investment income, and then distributions are taxed at ordinarily income tax rates unless they're rolled over into an IRA or another qualified plan of retirement. And so the vast majority of our clients, once the plan has become fully funded and reached its potential, most of our plan sponsors will then terminate their plans, roll them into an IRA, therefore delaying the taxes even further. And then once they reach age 72, they'll have to start taking about 3% of that money out per year and claiming it as taxes. Another benefit of these qualified plans is also protection from creditors. So lots of professionals like these vehicles for that reason, in addition to the deduction. When trying to help clients choose a retirement plan, we start with the simplest plans and move up the retirement plan food chain so we can find the plan that best fit it. Basic concepts are make the plan understandable, affordable, sustainable, and administratively feasible. Luckily, in this day and age, with a lot of the payroll companies out there, it's a lot easier administratively than it was back when I started working on these plans in the early 80s. We get some takeovers from time to time, and sometimes they appear to me to be overly complicated and really hard to understand. So unless there's a special need for a plan sponsor, we like to design these plans so that they're really easy for everyone to understand. And we'll discuss later on, the cash balance plan is much easier to understand than the traditional defined benefit plan. Let's see. All right. So as we move up the food chain, we find plans that offer more flexibility and/or higher tax deductions. Cash balance plans are at the top of the food chain, as we showed in the first exhibit. Prior to the Pension Protection Act of 2006, cash balance plans were relatively uncommon because small players, because there was a lack of legal clarity of whether or not you could do that. There were some court cases. The IBM is one in particular where they converted their traditional pension plan into a cash balance plan, and the participants took the plan sponsor to court. I think the participants lost that battle, but there were for quite a while there was some uncertainty whether or not you could actually whether a cash balance plan was a viable legal vehicle, but that problem's been solved. Cash balance plans are completely legal. In fact, in 2018, NOVA finally got a prototype plan document that's been signed off by the IRS. And so we're really happy to get that document and not have to worry about whether or not these vehicles would pass an audit. The number of cash balance plans in the small plan market has been increasing rapidly. The cash balance plans are most common, the most common new defined benefit plan type because they are easy to understand and communicate the annual cost, and we expect this to continue. Again, we'll compare that to a traditional defined benefit down the road. So here is a list of the plan types. There's SEPs, simple IRAs, profit sharing plans, ESOPs, 401k plans, which are similar to 403B and 457 with safe harbor, new comparability plans, defined benefit plans, cash balance plans, and cash balance combo plans. That's primarily what my department works on, is plan sponsors that sponsor both a profit sharing 401k plan along with the cash balance plan. One of the requirements for all these vehicles for the owner is to have income subject to self-employment taxes. We recently saw a new client, and I was talking, and they had a SEP. They had SEPs going on for several years, and so I asked for the prior compensation history for this plan sponsor, and they forwarded me to the CPA, and the CPA told me there wasn't really any self-employment income; it was just profits. And I asked the CPA, then how are you able to have a SEP if you had no income? And the CPA said, well, all my clients have that. And I said, oh, okay. Well, here is some IRS reference material, and I am really sure you need to have income subject to self-employment taxes as a basis for any benefit in any of these plans. So keep that in mind. If you have clients that just have royalties from oil wells or something like that, that would not be the type of income that you could use to base a benefit for in any of these vehicles. Retirement plans, non-discrimination testing. There's a handful of non-discrimination tests that may be applicable to a particular plan design. One of the things that NOVA does is confirm that all the IRS non-discrimination test requirements are met for our clients. And I'll refer to a few of these tests during the webinar as an ADP test or a top-heavy test, just to name a few. My real short 1-minute elevator speech, if someone asked me, what NOVA does, and that would be, well, I set up small plans for retirement plans for small businesses, and in general, the way it works, I can get a $200,000 to $250,000 deduction for the owner, but IRS requires that the owner gives the employee about 7.5% of pay through non-discrimination testing. So just a basic rule of thumb, if you do a combo plan, you're going to have to, the plan sponsor is going to have to give their participants 7.5% of pay between the two plans. Sometimes we can get it as low as maybe $500 plus 5% if we have the right demographics. But ballpark, you just if you're talking to a prospect, you would ask them what their company payroll is, and just multiply by 7.5% to just have a good ballpark feel for what the employee cost is going to be. And then any of the Nova salesmen can give you a chart that shows the deduction, like the one I sent on the first page, that shows you the approximate deduction at any given age. So you can really quickly just know, you can give your clients a good idea. All right, ballpark, we should be able to get you this, and it's going to cost you that. Then you talk to a Nova salesman and ask them to actually prepare a nice illustration for you. As a trade-off for letting owners save for retirement, deduct the contributions as a company expense. IRS requires plan sponsors give employees the minimum benefit. With the safe harbor 401k plans, the minimum contribution is 3 to 4%. With profit sharing contributions, typically the contribution is 5% or less. And then, as I had just mentioned, with the combo plans, the minimum benefit, $1,000 plus 7.5%, something like that. It really depends on your demographics. If you have old owners and young employees, the cost will typically come down some. Older employees are more expensive. Profit sharing safe harbor 401k plan. A 401k plan where the employer makes specified minimum contribution to all participants or only to non-highly compensated employees. That's what NHCE stands for, and satisfies some other conditions so that the plan is automatically deemed to pass certain IRS 401k non-discrimination tests, such as the average deferral percentage test or the average contribution percentage test. As we'll see later, when we talk about new comparability, the combination plans, it is important to consider advantages of a safe harbor plan design. I mean, basically, if your plan is not safe harbor, any money that the owner defers into the 401k plan might end up getting refunded back to them the following year if you don't get enough participation from the rank and file. If you make your plan a safe harbor, then you don't have to worry about what the non-highly compensated employees are doing. And here we have our first little example of a safe harbor profit sharing 401k plan. In this example, the owner makes $195,000. She defers $19,500 into the 401k plan through weekly payroll deductions. And then the 3% safe harbor contribution is $58.50. And then the non-highly compensated is 1 and 2. They can defer nothing. In this case, we show them both deferring $1,500. They both also 3%, and then they're also getting a 3% safe harbor contribution. So in this example, the plan sponsor spends $3,000 on their employees, and the total employer deduction is $8,700, $58.50 of which is going to the owner. So basically 67% of the employer contribution is going to the owner. And from a tax point of view, that's probably about break even. If you assume 1/3 would have been the tax rate anyway. So new comparability plan. So profit sharing 401k plan where the profit sharing contribution is determined based on job titles, classes, by participant name or other criteria. Relatively easy to understand. You have contribution flexibility. So if the plan sponsor has a good business year, they can make a profit sharing contribution, and if they don't, they can skip it. It is subject to special IRS testing and minimum gateway up to 5%, possibly. And the allocation is limited to the DC 415 limit. 57, I think it's 58,000 for 2021. And then there's a participant catch up of $6,500. So here we have our first example of a new comparability plan. You can hear sometimes people refer them to as new comp plans. So we have the same data. We have the same owner, age 60. We have two employees, same two employees making $50,000. We have the same deferrals. We have the same safe harbor, $1,500 to each employee. And then we are making a $38,500 profit sharing contribution to the owner. And we do some testing and we discover if we give each employee $1,000 profit sharing, we'll pass non-discrimination testing. And in this case, we are getting $38,500 of employer money to the owner out of the $43,500 employer contribution. That would be the deduction for the employer contribution on the tax return. And the owner is getting 88.5% of the employer contribution, in addition to being able to deduct or defer $19,500. So it's pretty darn good tax benefit. There's a pretty good example. And this is, you can see in this example, you got an owner age 60, employees are young, and this really shows the power of the demographics. If the employees had been 35 or 40, maybe they've been giving them $2,000 or $3,000 profit sharing contributions. So, but this is a pretty good example of the power of the new comp plan. Use of Safe Harbor 401k plan design with new comparability eliminates the ADP and ACP testing and allows the employer to vary only profit sharing contribution to satisfy non-discrimination testing. Safe Harbor contributions are applied to satisfying top-heavy minimum. So if we go back to that example, potentially you'd have 4 different types of non-discrimination testing going on here. You would have a non-discrimination test that would be looking at the deferrals. You would have a top-heavy test looking at what percentage of the benefits going to the owners. You would have a non-discrimination test on the percentage of the profit sharing benefit going to the owner. And so by making this a safe harbor plan, you eliminate the salary deferral discrimination test, and you satisfy the top-heavy test all in one fell swoop. So all we're worrying about is just one test, the profit sharing safe harbor test. So the safe harbor, most of the time we like to design our plans using the safe harbor contribution. There's 2 different ways to do safe harbor. You can do safe harbor matching, or you can do sort of a safe harbor profit sharing contribution. We prefer the safe harbor profit sharing contribution variety because the safe harbor match contribution does not count when looking at profit sharing contributions. Does not apply when looking at cash balance contributions. So we normally design our plans we call it safe harbor non-elective. You can just think of it as a 3% safe harbor profit sharing contribution that's 100% invested on day one. Non-elective safe harbor contributions, 3%, are also considered in non-discrimination testing under 401A4. Matching contributions are not. We just said that. Limiting safe harbor contributions to only non-highly compensated employees will provide contribution flexibility with new comp plans. So that's another plan design that's pretty standard here at NOVA. We see takeover plans all the time where the owner is getting the safe harbor contribution. We can just as easily give them that 3% contribution on the profit sharing side and not be handcuffed giving the owner a 3% safe harbor contribution. There's times with certain demographics that we need to limit the amount of money going to the owners, and so there's just some times where we don't want to give them any profit sharing contribution at all because it, in particular, when for small doctors and attorney practices that aren't covered by the Pension Benefit Guaranty Corporation, we can sometimes have to give the employees a lot of money, and but we can't give them more. We can't give more than 6% profit sharing contributions. In our first slide, we talked about that 6% profit sharing limit. Well, this is a long way around, but basically, the reason why we like to do safe harbor non-elective, like to exclude the owners, is that we don't have to get handcuffed by giving the owner 3%, half of that 6% contribution. All right, defined benefit plan. Traditional pension plan, which for many years was the standard form of employee retirement benefit for large businesses and unions, often used by small businesses to get large tax deductions, higher deductions than new comp plans for other older individuals, mandatory annual employer contributions, harder for advisors and clients to understand. So when I graduated, I have a degree in actuarial science, graduated in '81, and back then there wasn't even, the 401k plans weren't even in existence. They came into law, I think, about 1986. So back then, most plan businesses sponsored traditional defined benefit plans, which work a lot like Social Security. You retire and get a monthly stream of income for the rest of your life. And so that when you retired, you would have both your Social Security and your pension stream of income to make up maybe, 2/3 of your income. But what small business owners in particular found that younger employees don't see much value in when you give them a statement that shows them they're going to get a $4,500 a month annuity in 2042. It just doesn't resonate with them. So the cash balance plan, which shows everybody their benefit in terms of a current balance, gets a lot more appreciation and goodwill from their employees. One thing I really want to point out here, I'll circle it, is mandatory annual employer contribution. That is that's the IRS gotcha for businesses when they sponsor pension plans. You have to make a mandatory employer contribution. That mandatory amount comes from the actuarial report, which determines the annual minimum each year based on some required assumptions given to us, the actuaries, by the IRS. And that mandatory annual employer contribution is due on September 15th. So for my clients that sponsored pension plans in 2020, last week, September 15th, was the very last day to fund the plan for 2020. And unfortunately, we had a few clients that weren't able to meet their mandatory minimum. And so, for example, if the mandatory contribution was $50,000 and was not made by September 15th, that they missed a contribution. IRS charges a 10% excise tax for missed mandatory contributions. So in the case I just mentioned, $50,000, 10%, $5,000, the plan sponsor has to write a non-deductible $5,000 check to IRS, immediately after September 15th. That's the price tag of having one of these deals. So it's really important that you let your clients know, hey, this is mandatory, required by September 15th. Now, we like to encourage all of our clients to fund the plan on a quarterly basis, to maybe make the contribution at the same time they make their quarterly tax payment, and they do a true-up payment the the first quarter of the following year. Our clients who fund on a quarterly basis are our happiest clients, and don't have too many surprises down the road. So encourage your clients to fund quarterly if you can. Defined benefit plan. Benefit is typically a monthly annuity at retirement. We mentioned that. So an example a type of plan we would typically put together for a traditional defined benefit plan owner would be 10% of final 3-year average compensation. And so if you work 10 years and your salary is $100,000, then your monthly benefit or annual benefit, say at retirement age 65, would be 100%, $100,000. Exactly your pay. So it's a really lucrative benefit. That's typically how we design a traditional benefit plan for an owner. You wouldn't want to give your employees that much because that'd be really expensive. Imagine having an employee work for you for 5 years, from 45 to 50, and say maybe their salary is $50,000. They worked 5 years, so they get 50% of that. So that employee leaves you after 5 years and then has a $25,000 annuity payable to them the rest of their life beginning at 65, which is pretty much equal to their Social Security benefit. Only the only difference is they only work for the employer for 5 years, not their whole career. So we wouldn't want to design a plan that way. We did see one come like that at Checkover recently, and we changed the formula immediately, but there were some expensive benefits owed to those employees. Defined benefit. The maximum benefit is based on an IRS annual annuity of $230,000 for 2021. So that's an annuity amount. That's not the deduction. That's the benefit that can be funded for. Contributions to the plan are determined by the enrolled actuary after calculating the present value of the monthly benefit promised in the future, and then comparing that to the amount of assets in the plan. And the benefits earned under the plan are obligation of the sponsor employer. As such, the employer must follow the actuary's funding instructions or face severe penalties. We mentioned the 10%. Defined benefit fun fact. Who can have the largest defined benefit? Elon Musk, Tom Brady, or a small plan owner? Do we have any guesses? And the answer is the maximum benefit for Elon Musk, Tom Brady, and the small owner are all the same. It's the $200,000 annual annuity at 62. And the maximum annuity amount is less if paid before 62. The maximum annuity is more if paid after 65. And then just for example, Tom Brady's maximum annuity at 45, what is he, 40 years old now? So if he works another 5 years, he could retire with a $6,500 a month pension. That's the maximum under IRS. I doubt that would be enough to cover Giselle's weekly allowance, but well, actually, she makes more than he does, so she probably doesn't need an allowance. Let's see. All right, the power of the cash balance plan. So here on this chart, we show the approximate maximum lump sums at different ages. So at 55, it's $2,000. So if you have a sponsor who starts a plan at 45, you can target $200,000 after 10 years. And at 55, they would terminate the plan, roll it into an IRA, and be done with the pension plan. And as you can see, the numbers go up higher. They level off, actually drop a little bit between 62 and 65, and then they increase from 65 to 70 back up to about $3 million. We're going to get a cost of living increase from IRS this year, so I'm hoping these numbers maybe go up 5% next year. And then this chart basically will show the maximum deduction at any given age. So if you came to NOVA with a plan sponsor age 55, if his salary was at least $145,000, if the salary was at least $145,000, we could probably get you a deduction for that client of about $210,000 a year. There's a chart that the salesmen have that they can share with you, so you can kind of get an idea of what kind of deduction you can get for your clients. Cash balance plan, what is it? A defined benefit plan, also called a hybrid plan, that looks and operates somewhat like a defined contribution plan. Think of it like a guaranteed profit sharing plan. Benefits expressed as a hypothetical account balance with guaranteed annual allocations that are called pay credits or contributions, and interest or interest credits. The payout as a single lump sum at termination of employment, and the calculations are required by an enrolled actuary to ensure plan is funded at required minimum levels to provide account balances when due. And unlike a defined contribution plan, assets do not typically equal liabilities. That's almost impossible to happen, because obviously the account balances or the assets are fluctuating every day with the market. So even if the benefits are 100,000 and the plan sponsor contributes 100,000, in a week or two, the assets will have gone up or gone down. Another fun fact. Okay, I don't need to know anything about plan assets or how the assets have performed to calculate the benefit. All you need is a plan document and salary history sometimes. Sometimes when I meet with the plan sponsors and their advisors, and they're asking about plan liabilities, they normally want to tell me what's in the plan, and I surprise them and say, I don't need to know what's in the plan to calculate the liability. The liability comes from the plan document, and the interest rate that is defined in the plan document. So it has nothing to do with the assets. The benefits aren't tied to assets at all. That's a unique feature of a defined benefit plan or a cash balance plan. Cash balance plan, how does it work? A hypothetical notional account is established for each participant. Contributions and interest are credited annually to each individual account according to the plan provisions in the plan document. Hypothetical contributions and interest are limited by plan design so that the equivalent annual amount at retirement is limited as under any other defined benefit plan. Remember, it's a defined benefit plan, so hypothetical contributions not limited as under a defined contribution plan. So there's no $57,000 limit. Interest credit is written into the plan document. It's not typically the actual return earned by the plan. Here's a cash balance plan sample participant statement. In this example, the participant, this is obviously a non-highly compensated employee, had an account balance of $2,000 and 1/120, gets the 5% interest credit as defined in the plan document, gets a $1,000 contribution as defined in the plan document, and their account balance at 12/31/20 is $3,100. And you and I, we can all calculate this out through 2025 following the exact same cookie cutter formula. So we could tell the plan sponsor what the liabilities will be in a year out into the future. Very easy. Cash balance plan, sample plan formula. So this would be a one potential formula. Owners get 75% of compensation. Highly compensated employees other than owners get 20% of compensation. All others get 50% of compensation. A cash balance plan can allow for classes like new comparability plan, but with higher limits. Annual non-discrimination testing is required. Here's another example of this is a more standard cash balance formula that you would see here at NOVA for most of our small plan sponsors. Owners get $150,000 a year, or $200,000 a year, or $250,000 a year, depending on their age. The plan does not give the other highly compensated non-owners anything. We exclude them from the cash balance plan, and then we give all the employees $1,000 a year. Now, one of the reasons we exclude non-owner highly compensated employees from the cash balance plan is because we do not want to force the owner to have to give those employees a 5% top-heavy benefit. If we exclude the non-owner highly compensated employees from the cash balance plan, then the owner only has to give those employees a 3% top-heavy benefit. If they want to give them, 2% more, give them 5%, they can, or they can get whatever they want to give them. But sometimes you'll see some highly compensated non-owners who make $250,000 a year, and the owner doesn't want to give them a 5% top heavy. So here's another typical cash balance plan example. You've got two owners, one age 58, one 60. Both make maximum IRS comp, $285,000. That's up to $290 this year in 2021. Their cash balance benefits are $213,000 a year. And then the staff, in this example, has a range of benefits ranging from $2,250 to $5,250. Cash balance combination plan is even better in combination with the defined contribution plan. So in this example, let's see, we combine a 401k profit sharing plan with the cash balance plan and test the combined plan for non-discrimination under the Internal Revenue Code 401-849. Provides for the highest level of combined benefits and tax deductions for plans sponsored by closely held companies. Usually cross-tested on a benefits basis. Enhanced minimum gateway, the minimum goes up to 7.5% now. And then we combine that with the safe harbor 401k plan design, especially non-elective safe harbor, 3% to non-highly compensated only, aids in passing the gateway and non-discrimination testing. And then here's that same, so this is the same example as before, but in this example, the owners get the same cash balance benefit. We reduce the cash balance benefit to the employees from $2,000 to $5,000 to $300 to $500. But now we're giving them a 3% safe harbor and 2% profit sharing or 5% profit sharing, and we are saving the owners $14,000 in employee cost, and we're able to get the owners an extra $130,000. Cash balance plan advantages. Easier to understand the traditional defined benefit for both plan sponsor and the participant. Easier for plan sponsor to budget contributions, understand employee costs. Participants understand what was contributed on their behalf. If the asset allocation is highly correlated to the interest crediting rate written into the plan document, plan assets and liabilities will be tightly connected. I do like to point this out to advisors. When you think about the cash balance plan, hopefully you have 90–95% of the money going to the owner. So the employees are getting a token minimum benefit, $1,000 a piece, maybe as low as $500 a piece. And so it's a really, really small amount. So at the end of the day, the plan sponsor terminates the plan and pays out the employees their token benefit, and whatever's left is theirs. And so, how the plan does, the investment return really can just correspond to what their personal preferences for their own personal investment policy, whatever they're comfortable doing. If they want to be more aggressive and willing to take the ups and downs with a more aggressive portfolio, that's fine, because really you're going to give the owners a 5% interest credit on a really small benefit. So all that money is pretty immaterial. The investments, how that does really winds up in the owner's pocket one way or the other. So I think sometimes there's a lot of too much excitement made about the interest credit. The plan sponsor can just choose an investment policy that makes sense for them, and then just however that works out, however the market does during the time the plan's in effect, will be they'll benefit from or take the hit. Cash balance plan advantages under new tax laws. So Section 199A of the Tax Cut and Jobs Act allows deduction of up to 20% of qualified business income, QBI, for pass-through entities. Those would be sole proprietorships, partnerships, S corps. The deductible QBI amount is generally 20% of QBI, but it may be limited when the business is a specified service, trade, or business. Taxable income is greater than 145,000. Specified service, trade or business. Any trade or business involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. It's a mouthful. Check with your CPAs if you have any questions, if it applies to your sponsor. But here's an example. Adjusted gross income of $600,000. And we have an example with and without a cash balance plan. So without the cash balance plan, the deduction is $55,000. With the cash balance plan, the deduction is $285,000. Adjusted gross income after deductions, $545,000. Without the cash balance, $252,000. With the cash balance, and you see the difference in estimated taxes is almost $100,000. So that's a pretty darn big win. You've just probably made a $250,000 deduction for the owners and saved them $100,000 in taxes. So pretty good deal. Cash balance plan advantages under the new tax law. The owner is the only participant in the cash. Illustration sample assumptions. The owner is the only participant in the cash balance plan. Participant's tax filing status is married filing jointly. The business is deemed to be a specified service, trade, or business. Other deductions are ignored. Cash balance deduction is less than the maximum deductible contribution available. All right, let's just do assumptions. Cash balance plan requirements, required annual contribution, not discretionary. Remember, it's a defined benefit plan. Got to make that contribution by September 15th. Generally closed to allocated amount. The annual contribution is usually generally close to the allocated amount, but could be higher or lower. So, for example, if you set up a plan where the benefits are about $200,000 a year, the deduction is going to be the contribution is going to be about $200,000 a year. In a traditional defined benefit plan, it can be much lower, much higher. But in the cash balance plan, whatever the owner signs up for is pretty much what it's going to be every year. In-service distributions are allowed at age 59.5, thanks to the Secure Act. It used to be 62, but now it's 59.5. Most of our plans don't have in-service distribution clauses, but in partnership plans, I have a partner plan in Austin that recently the partners wanted to put in an age 59.5 in-service distribution. The plan had been in place 10 years, and a lot of those partners had $2 million balances, and they wanted to invest the money in some different fashion other than what was in the cash balance plan. So they put in an in-service distribution and then rolled the money into an IRA, and then they could invest the money with their advisors however they saw fit. So sometimes in partnership plans, this would be a desirable plan provision. And then in a cash balance plan, there's three-year vesting. So after 3 years, participants are fully vested. That's just a legal requirement. And remember, in the profit sharing plan, it's usually a 6-year graded schedule, 20% after 2 years, 40% after 3 years, 100% after 6 years in the profit sharing. Cash balance plan requirements, spouse must consent to take the distribution in the form of a lump sum. If the spouse does not agree to allow the owner to take the distribution in the form of a lump sum, the owner will have to take the benefit in the form of an annuity. It's rare to see a spouse not sign off on it, but we've had situations where the spouse would not agree to sign off to have the money rolled over into an IRA or pay out as a lump sum. And the owner was forced to take a monthly annuity rather than the lump sum. So it's good for the plan sponsors to know that there's in advance that your wife will have to agree to sign off on the lump sum payment at the end. Cash balance plans are not participant directed. Like all defined benefit plans, assets are trustee directed. So the plan sponsor takes all the investment risk. PBGC premiums for some plans. So there's a PBGC premium of about $85 a year per participant in plans that are covered by the Pension Benefit Guaranty Corporation. There's exceptions to that. Small professional films and owner-only firms are not covered by the Pension Benefit Guaranty Corporation. And then we say budget $90 per participant as an additional cost if your plan is covered by the Pension Benefit Guaranty Corporation. Our NOVA illustrations will always point out whether or not the plan is covered by PBGC. The NOVA salesman will let you all know if that's an additional cost for the plan sponsor. It doesn't apply to doctors and lawyers and that sort of thing, but if you have a manufacturer or a fast food chain, then it would apply. Frequently asked questions. Who would be interested in a cash balance plan? Professional firms, physicians, dentists, attorneys, those are the ones we see most often. Lately, we've been seeing lots of restaurants, some of these restaurant chains where the home office pays for 50% of the employee side of the benefit. So that normally when you have fast food and you've got just an owner and a spouse and 40, 50 employees, it's not normally attractive to set up one of these combo plans. But if the fast food chain home office is willing to pay for half the employee portion of the benefit, it all of a sudden becomes attractive. So we've seen a lot of that lately. Owner-operated businesses, especially if the owner's over age 50. Companies transitioning from an older owner to a younger owner. Sometimes it's a way if the owner's getting bought out and maybe plans to be bought out down the road, you could have the potential suitor fund the pension plan for the owner, and the owner could then get a good portion of his payout in a non-taxable fashion. So talk to our NOVA salesman if you think you might have a client like that. Then we have large companies looking for a defined benefit plan their employees can understand. So see, who would be interested in a cash balance plan? Workforce where the staff is 10 or more years younger than the owner. Companies looking for a maximum deductible contribution. Companies with steady, predictable cash flow. Because the contributions, if you sign up for a $200,000 a year benefit, you're going to have to put in $200,000 a year. So it's not good for maybe a real estate person whose compensation fluctuates, from year to year, 600,000 one year, zero the next. May not make sense for that type of business. Companies with steady, predictable cash flow. Companies with a new comp plan. If you have clients that have a new comp plan that don't have a cash balance plan, you might ask your NOVA sales representative to run an illustration for you to see if that might make sense. And then organizations with an existing defined benefit plan may want to convert to a cash balance plan. Why would a company with a new comparability plan be interested in a cash balance plan? Often these companies budget 7% plus for their employees and can add a cash balance plan benefiting owners with a proportionally small additional cost for employees. Yeah, I've actually seen some plans in NOVA that have this. They've been maxing out the owners in the profit sharing and giving the employees 5%, and I can get them an extra $100,000 or $200,000 deduction for maybe another 0.5%. Might be up to 2.5%, but sometimes the demographics right, there's almost no additional cost to do this. If you know of a company with a new comp plan that would like to see if they can add a cash balance plan with only a marginal additional cost, staff cost, please send NOVA last year's allocation report, and we can run an illustration for you. Yeah, so just send us last year's funding illustration. If cash balance plans are so cool, why haven't I heard of them before? Cash balance plans have been common in the large plan market for years. In the small plan market, they have been much less common because concern regarding their legal status. There used to be a 25% pay deduction limit when there was a DC plan. That's gone away. And previously, there was no pre-approved documents. If cash balance plans are so cool, why haven't I heard of them? Let's see. In August 2006, Congress passed Pension Protection Act. So it clarified the legal status of these plans, and it basically eliminated the 25% pay deduction rules if the plan was covered by PBGC, or if the profit sharing contribution was less than 6%. So this 25% pay deduction limit used to be a big sticking problem for these plans. That's been eliminated. And I mentioned earlier on why we like to do, why we don't do safe harbor match. It's because of this whole 25% deal that can kick in if we're not able to meet non-discrimination with only 6%. So we just like to keep all of our options open. What is the interest crediting rate? PPA specifies that the interest crediting rate cannot exceed a reasonable market rate of return, acceptable to use a reasonable minimum rate of return, or the greater of a reasonable market rate and a fixed rate. Preservation of capital, cumulative account balance cannot be less than the contributions. That's just a law. Avoid estimates that frequently have a negative return. The IRS issued additional guidance on cash balance interest rates, common interest rate crediting rate, 30-year treasury, 10-year bond rate, fixed rate up to 6%. We normally do 5% because that corresponds with the IRS maximum benefit that we can get the owner. There's some math there that makes that percentage desirable. But we design plans sometimes with a 3% rate of return, a 4% rate of return. If it helps us pass testing, kind of depends on the demographics. If you want to talk about interest credit rates more, get with your Nova salesman, and all three of us can bat it around. It can be a tricky discussion. The IRS issued additional guidance on cash balance plan interest rates, which includes returns on certain mutual funds and the actual rate of return on plan assets. These are some serious technical issues with these. You can really work against a plan sponsor. If you can set up a plan with a $250,000 deduction, and you could possibly not have that deduction available to you the next year if the plan earned 20%, because you have to project the benefits using last year's rate of return. So if the plan earned 20% last year and you put in $200,000 and you assume the plan is going to earn 20% between now and normal retirement age, the next thing you know, you're over the IRS max and you don't have a deduction available. So it's just kind of one of the problems with this. With using an interest rate that would say you call it interest rate the S&P 500. It can just cause some real tough non-discrimination problems. Fact, what is considered compensation? Remember, you must have compensation to do any kind of plan. So what's acceptable? W-2 comp, Schedule C, line 31. K1 line 14, must pay self-employment taxes, otherwise not considered compensation. No compensation, no benefit. Remember, that's why it's really important to get with the CPA and make sure they know that their plan sponsor has to have self-employment income to make this plan work. Unfortunately, I just had one today that the CPA said, oh yeah, we didn't do any W-2 last year because we went from sole proprietor to an S Corp, C Corp, and we were just going to skip it for 2020. Like, well, you set up a plan for 2020, and you have to have comp. So you have to have compensation. Remember that. Really important point. Does the plan's investment allocation have to match the plan's interest crediting rate? No, it does not. Risk-averse clients will probably want the plan's actual investment allocation to be correlated to the plan's interest crediting rate. Other clients may choose interest crediting rate and then allocate the plan's assets to try and beat that rate. Beware of ending up with an underfunded plan. Really, again, at the end of the day, the token money goes to the employees. What's left is the owner. People make too big of a deal about all this, and I'd be happy to participate in a conversation where this is the topic. I think if we understand that really the employee benefits are not really that important, the employee's interest crediting rate is not important, the interest crediting rate itself is not important. Choose it to pass non-discrimination tests, keep employee costs down, invest the money however you want. May an existing defined benefit plan be converted into a cash balance plan? Yes, it's really complicated, can be expensive. We almost might recommend a plan termination instead and start over, but we can look at that. We do have a few of those in here. What is the IRC 401(a)(26) requirement? General rule is pension plans must cover at least 40% of their employees. So if you have a husband and wife and and just 3 employees, you can just cover the husband and wife, but you got to cover at least 40% of your employees. The minimum allocation gateway, we talked about that before. It's basically 7.5% of pay. You know, you set the plans. It's almost 2 o'clock, so I don't want to keep you all too long. How long does a plan sponsor need to maintain a plan? General rule of thumb is 5 years. If you have a good business reason for terminating before 5 years, you probably could talk your way out of it. We actually haven't seen a lot of audits or challenges on the 5-year rule even. So, but really, it's a good idea to tell your clients, plan on having them at least 5 years. That's been a kind of guidance we've got behind the scenes at IRS seminars. Deadline to adopt a plan. The deadline is actually the tax due date, the due date of the tax return. But for 2021, anybody who wants to adopt a plan for 21, we like to recommend you get this plan in place by January 31st, just to give us plenty of time. There's a lot of work that needs to happen once the plan sponsor decides they want a plan. The deadline to adopt a plan, if the plan sponsor wants to have it in place before December 31st of this year, would be December 10th. So that means you need to submit your request before that, maybe a week before that, in early December, if you want to get a plan in place before the plan year end and make the deposit. Remember to tell your CPA and ask him to prepare a mock tax return. Deadline to adopt the plan. Remember, don't fund the plan until the plan is adopted and signed and dated. Don't fund the plan until you get a signed actuarial report which states the maximum deduction. Best to fund the plan quarterly. All right, folks, CPA credit, remember to return your evaluation form and you'll receive a certificate with 1 week. Really appreciate everybody attending this webinar. Get with your Nova salesman if you have any questions. If you'd like to talk some actuarial deep dive stuff, let your salesman know, and we can probably have a little chat about that. Interest rates, interest crediting rates, investment policy, stuff like that. I can help talk about some of the technical stuff.
Thanks, Ernie. We actually haven't received any questions either, so thank you for all that helpful information, and thank you to everyone for joining us today for our webinar on cash balance plans. Please note it is very important that you complete the survey that will pop up right after this webinar, and if you need any of the CE credits offered, and specifically for the CFP CE, please make sure you provide us with the last 4 of your social and your full CFP board ID. The certificates will be sent out by the end of next week, and if you have any questions, please email us at webinars@nova401k.com. We hope everyone has a terrific Thursday.